Today we'll dive into another essential financial document for your business, the Profit and Loss Statement, also known as the P&L or Income Statement. If you've ever wondered how to read one or what makes a healthy P&L, you're in the right place. Let's break it down step by step, and I'll include examples to make everything crystal clear. The Profit and Loss Statement shows your business's performance over a specific period of time, monthly, quarterly, or annually. It answers the fundamental question: did your business make a profit or incur a loss? It consists of several key components: income, direct costs, overheads, operating expenses, gross margin, net profit. Let's break these down with this example. Income is the money your business earns from selling goods or services. This is often referred to as revenue or sales. For example, let's say you own a bakery. Over the past month, you've sold $19,654.09 worth of cakes, pastries, and bread, net of GST. That amount is your income. A healthy P&L shows consistent or growing income over time. Tracking income regularly helps you identify patterns and areas for growth. Next, we have direct costs, also known as the cost of goods sold, COGS. These are the expenses directly tied to producing your products or services. Using our bakery example, direct costs might include flour, sugar, and other ingredients totaling $590.91 for the month. Subtracting direct costs from income gives you your gross margin, which we will discuss shortly. Now let's talk about overheads. These are the ongoing expenses required to run your business but aren't directly tied to production. Common examples include rent for your bakery space, $1,500, light, power and heating, $295, advertising, $1,818.18, admin and manager wages, $13,400. In total, your overheads for the month are $17,965.22. Managing overheads effectively is crucial for a healthy P&L. Your gross margin is sometimes called gross profit and is calculated by subtracting direct costs from income. It shows how efficiently your business produces goods or services. In our bakery example, income, $19,654.09. Direct costs, $590.91. Gross margin, $19,063.18. A high gross margin indicates strong production efficiency and good pricing. For example, in general, if your margin percentage is 50% or higher, it's a sign that your pricing strategy and cost management are working well. However, the percentage does change industry to industry, so be sure to discuss this with your accountant. The gross margin percentage in our example here is 97%. Finally, we arrive at net profit. This is what's left after you subtract both direct costs and overheads from your income. It represents the actual profit your business has made. In our example, gross margin, $19,063.18. Overheads, $17,965.22. Net profit, $1,097.96. This is your bottom line. A healthy P&L will show consistent or increasing net profits over time. Now, what makes a healthy profit and loss statement? Here are a few key indicators. 1. Growing income. Steady or increasing revenue over time is a great sign of business growth. For example, in a bakery, we would like to see monthly income rise as this shows strong demand. It's also important to ensure that income is growing by more than the rate of inflation. 2. Controlled costs. Overheads should remain stable as income grows, and direct costs should grow in proportion to the increase in revenue. Keep an eye on expenses to ensure they don't outpace revenue. For instance, if ingredient costs rise, you might need to adjust pricing to maintain margins. 3. Healthy gross margin. Aim for a high gross margin to cover overheads and ensure profitability. A gross margin of 50% means half your income is available to cover overheads and profit. Be sure to account for wages for your productive team members as part of cost of goods sold. Your payroll system can help you do that. Ask your accountant for help to set this up in your accounting system. Our bakery example seems to have made this error. The baking and sales team wages should be accounted for as part of cost of goods sold. Management wages should be recorded as an overhead. 4. Consistent net profit. Your net profit should be growing or at least stable. If it's declining, investigate causes like rising costs or shrinking sales. 5. Clear trends. Regularly review your profit and loss statement to identify trends and make informed decisions. Ensure revenue and profit is increasing by at least the inflation rate. If not, the purchasing power of your profit is going backwards and your standard of living will decline. For example, if sales dip in winter, plan promotions to boost income during slower months, or alternatively, introduce a special winter item for sale. Another critical concept is the break-even point. This is the point at which your business's total revenue equals its total costs, both direct costs and overheads. In other words, it's the sales level where you're neither making a profit nor a loss. To calculate your break-even point, use this formula: break-even point in sales equals total fixed costs divided by the selling price per unit less variable costs per unit. Let's use an example. If fixed costs overheads are $4,000, and the selling price per unit is $10, and the variable cost per unit, i.e. direct costs, are $6, then the break-even point is 4,000 divided by 10 minus 6, which equals 1,000 units. This means you need to sell 1,000 units to cover all your costs. Understanding your break-even point helps you set realistic sales targets and correct pricing strategies. A healthy profit and loss statement doesn't just reflect profitability, it also highlights areas for improvement. By understanding gross margins, addressing turnover, and calculating your break-even point, you can make informed decisions to strengthen your business's financial performance. Understanding your profit and loss statement is essential for running a successful business. It helps you monitor performance, manage costs, and plan for growth. If you're ever unsure about your P&L, reach out, we can help. If you would like to learn more about your financial statements, check out our online small business course. The link is in the description.